This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes. G'day. Welcome to another episode of Wealth and Toil. My name is Dylan Pargiter-Green, Director at Bold Wealth, and I'm here, as always, with my partner in podcasting, the man in the markets, Mr. Luke Laretive. How are you, sir?
I like that intro. That's quite good from you, Dill. How are you, mate? Good, I'm well.
That's good.
Bit tired, but I'm well. Bit tired.
Well, busy week, but I think we'll get to that. I don't think we need to, I don't think we need to give the listeners all of the gold at the start of the podcast.
The victory lap will commence shortly.
Should we say all of the silver? But anyway. Ooh. No, but it's been a busy week for you, busy week for me as well.
Both on the road.
Both on the road this week, couple of different conferences. I think we both were on the Equity Mates podcast this week, our good friends.
Ooh, we were we? I did. Were you on? Did your episode come out? Did it?
I think it came out. This week, which
that's a pretty slow turnaround from the boys at Equity Mates. I might have to have a word to them.
Hey. We don't want to give away to their audience about their recording schedule. Right? I think I saw a post from you on LinkedIn saying you recorded something back in March. Although, interestingly,
it was elite. It was an elite call. I made it back in March, and then they put it out this week.
Well, Pimp My Portfolio this week, just for everyone that knows, that's a podcast segment that our good mates at Equity Mates, shout out to Bryce and Wren, do with some peanut investor called Luke Laretive from Seneca. But no, you gave some advice to a young chap, I can't remember his name, about JB Hi-Fi.
Yeah, we talked about JB Hi-Fi, and we talked about how at Seneca we, for probably the last 12 months, to be honest, have been underweight and largely avoiding what we call low-quality consumer discretionary. For the simple fact that we think households are under pressure, we think their budgets are under pressure, and we think that's going to result in a cyclical downturn in consumer spending at the likes of JB Hi-Fi, Harvey Norman, insert other general high street retailer here. But those stocks have actually been performing really well, and they've actually had pretty good earnings, and as a result, they've been bid up dramatically on the back of that they're high quality and that they're going to sort of perform pretty well during this sort of high, the consumer's quite resilient, I should say.
I think they had better than expected earnings throughout 2022 and 23. Is that
positive growth when everyone sort of thought they'd go backwards, and not that it was ripping. I think JB's did like 8%, but my main my thesis was that that this would all kind of go away, and we didn't want to be, we call that sort of investing dancing with the devil. You can be right for a short period of time, but and that's fine. But you've also got to be good enough to get out of that trade before the music stops. So the music stopped.
I don't think a lot of people would have seen that coming. Like those people that were in it might have been in it accidentally. I think coming out of COVID, there was an expectation that people might spend a little bit, but the length of it was much longer, the length of sort of consumer spending over that time. But now you're finally sort of seeing that weight of the interest rate changes affect people's consumer spending fairly significantly. And I mean, yeah, it was cool. You called it 3 months ago. It's a very timely episode. I had a very good chuckle to myself when I think there was an article somewhere, potentially the AFR was talking about JB Hi-Fi being in a little bit of crisis.
I wouldn't say crisis, but I mean,
this is the media though.
I know. But all I would say is that, like, I'm not saying that JB's isn't a good business. I'm just saying that it's just not that special that you think there's no retailer that's special and isn't sensitive to the economy. So it was a reasonable call. It's worked out well for us. But it's a good example of active, I suppose, taking its time sometimes to play for things to work out. and you need to be patient. And so, you can invest with a good fund manager. They might have a period of underperformance as a result of a sort of a view they've taken. The chances are, that can take 6 or 12 months to play out the way that they think. And that's the nature of active investing. You are wrong until you are right. I'm going to get a tattoo of it on my forehead. In any case.
If you get it done in Bali, it'll probably say you are right until you're wrong. So,
if only that were true. Now, Dill, the most boring piece of financial news for the year happened this week. Believe it or not,
happens every year, same day every year.
And I really pay no attention to politics, and I really pay no attention to the budget. But for those regular Joes who do like the budget and are interested in what it means for them, give me 3 takeaways that I care about.
All right. So, Mr. Chalmers stood up and delivered his speech on Tuesday night or whichever the day of the week that it actually happens on. And everything that came out was the very much expected, already told policies, as tends to be the way with politics. So, you and I know this. I'm much like you. Politics is so central in Australia. I think that most of the policies tend to fall exactly where we expect them to. The biggest news, which isn't really news, is the stage 3 tax cuts being put through officially. What that looks like for those that weren't aware, that the previous government, the Morrison government, brought in a series of tax cuts on over a period of time, which were to effectively reduce overall income tax. There was going to be, for the top marginal tax bracket, about a $9,000 difference after this stage 3 tax cut. So
more or less?
Less tax. So all of these are tax cuts. It's in the name.
Suits me.
Well, suits you. Someone's doing well. No, but no. So that tax cut has now been reduced. So now it's about $4,300. I think that the overall rhetoric on it is it's a bad thing for higher income earners. That's been reallocated to some sort of lower and middle income earners. For society, it's probably a good thing. For general growth, it's actually probably a good thing because those people contribute more to spending. It means probably faster allocation back into jobs, and then if you work on what an economist would say is the tax roundabout, a lot of more of it will come back to the government sooner in the form of GST. So that's the big one. Look, it's not a huge deal, and a lot of my clients will get really up and about this. They're working with people in that upper income bracket. They'll say, "Oh, the government's robbing me." Blah blah blah. It's like,
they're always robbing us. That doesn't change.
They're always robbing us. Maybe. The reality is that, like, we really, and this is my advice to all my clients, that we should not be worried. We should not be getting up in arms about money that has not yet been given to us. Yet tax cuts are they're a good thing. Tax increases, not so good. That's where you end up with less, rather than here you are ending up with more still. But if you're putting your energy into worrying about $4,000, $5,000.
Yeah.
Like
you have to ask yourself.
You have to ask yourself, what do you, if that's keeping you up at night? It's not that it's, for some people, it's not an insignificant amount of money, but for a lot of the people that we're talking to, like, put your energy into doing good things with what you are getting, and that difference between 4 and 9 won't make you bat an eyelid.
Yeah, I mean, look, I'm glad that there's not much change, and it's all seems pretty straightforward. What about the big argument I'm hearing is it's inflationary, it's an expansionary budget. And, if you go to uni, they'll tell you that in an ideal world, in a stylized environment, you're supposed to have, fiscal and monetary policy working in the same directions. And we should have rising interest rates and a contractionary budget. And we should have falling interest rates in an expansionary budget. I don't think it's too expansionary from what I've read. And I think someone was trying to say to me, what about the money they're taking off the rebate for power bills or whatever? I was like, well, no one's going to spend that money. Like, then it's money you never had, so you're not going to actually go and buy a Gucci handbag with it. So, like, let's I don't know. It didn't seem too bad to me. It's sort of thumb suck.
Yeah, it was a pretty balanced budget, I thought. Look, one thing that is ignored and has a fundamentally much larger impact over an extended period of time is immigration.
Mm-hmm.
During 2020 to 2022, we had net negative migration. And as a result, when the borders reopened, we actually had a lot of people coming back, which is good, but we also then had a lot more visa positions to fill to backlog that. That, in my opinion, has been one of the reasons that we have seen increased consumption, maintained low unemployment, because we had higher than average year-on-year immigration. And that was a policy that was part of this government. They've then actually gone back on that. They flipped. Fewer new people to the country will mean less spending, and that will have a larger contractionary effect than what the difference in tax cuts and the discretionary spending that will come from that. Because those people, one of those people earning median wage is the equivalent of about 50 people at median wage tax cut in spending per year.
Yeah. So it's not the size of the change; it's the number of people it applies to. Is probably what you're going to say.
And also, one of the biggest and most stickiest parts of inflation is housing.
Yeah,
and supply and demand drives housing. So,
I hope that's still the case. Should we have the supply and demand of credit, not supply and demand of housing is what drives housing? No, we won't do that today.
There's another time. So, really, really quickly, a couple of other things that are in the budget. Small business support. So, you and I have a lot of small business clients. Extension of instant asset write-offs. So businesses with under sub $10 million turnover can still write off certain assets up to $20,000 a year in 1 year without needing to depreciate that asset.
Give me an example. What can I write off? This is now a consulting session for Luke. Yeah, go on.
The cars that you drive, mate, you can't write anything like that off. But a good example might be plant or equipment or new computers or something like that. So you still
don't get to write off luxury cars, is what you're trying to tell me.
Well, you can. I mean, that was in you just.
That's what that was. Yeah, okay.
And you can only depreciate up to $60,000. So. Yeah. Anyway,
it's not going to cut it.
Fact check that stat. Yeah. It's still $60,000 more that you can depreciate off a car than you otherwise would. But
very good.
Yeah,
very good. Final point, or you want to move on, Sammy?
Final point, and it's just because it was last week's podcast, is the help debt or HECS debt. The government has agreed to not charge people what they did last year and the 7.1% indexation.
I don't like this. I think it sets it's babying people. I think if you're fortunate enough to live in a place, I mean, I love university system. I'd love to go to university. I think it's the most formative thing for middle class people to do. But we should all just wear our whack. Like, we had some inflation and your loans adjusted by inflation. Like, that's just
I think
people need to learn that the world's not there to serve them, and it's a bit like tough titties sometimes, and you need to, it's the big bad world.
I would say that the reduction is that they don't. It's not that they don't have to pay it. It's that it's been brought back to whatever the mandated wage increase level is. So it's to keep pace with wages. It's still last year. I think it was still 3.9 or thereabouts.
I understand the principle. I understand the principle of indexing it to wages, but the university system and your loan for a university loan is there to pay for your education. It's not there to give you a job. If it was there to give you a job, there'd be lots of degrees that wouldn't exist. So I think that whilst we should use university to help us gain employment, not everybody does. And just because if the value of money changes and the value of your loan and the government's recouping of that loan, I think should change with the value of money, not the value of work.
No, strong point. I think like I said last year, if any young people pre-university or any parents who are guiding young people are listening, a really good conversation to have is about the fact that university isn't free. And whilst you are generally going to expand your knowledge, if people are concerned about expanding their knowledge in an area that they're concerned about income, then think about funding education for your kids in different ways, and or, helping them make choices that will lead to, fruitful employment later on.
That's my favourite podcaster, Scott Galloway, says you should find something that you're good at with a 95% employment rate.
Yeah, absolutely. Supply and demand.
They're the concentric circles of university. Okay.
Now we want to talk about. All right.
Push on, Sammy. I've had enough. I've had enough of this shit. It's so boring. So boring.
Anyway, we will very much attempt to not talk about political announcements in future because it makes Luke sad. However,
flatten me right out.
There is also a bit that's been going on this week in the markets.
What's going on in the markets this week? Market's on a tear.
The market's on a tear, but there was one thing that happened this week that I thought, it's nice to talk about, just because we have some inside information.
No, we don't have any inside information.
Oh, not like
we never have any inside information. We are exceptionally good at identifying certain things.
Luke, you had an involvement this week, or for the past few months, I should say, in the IPO of a little company called Sun Silver, which, from everything that I've seen, went pretty well. So tell us a bit about it.
Yeah, it's been a good week, Dill. It's been a good week.
Week.
So Sun Silver, code's SS1. We sort of cornerstone that IPO with our fund, our small caps fund, and our clients. And yeah, it's done really well. So we listed that was at 20 cents or 25 mil market cap. I think it's trading at 57, 58 cents at the moment.
Well done.
It's been a nice little win for the week. So pleased for the clients and the team as well, because doing that stuff it requires a lot of things to be lined up, whether that's years of sort of networking and meeting people and sorting out those people who are dodgy.
That's hard yards.
Not good operators, and you got to get through all that, and then you finally get to the people that you like to work with, and then they got to bring you a deal that you like, and then that deal's got to be, you got to do due diligence on it and figure it out and make sure it's right, and then you might give it to your clients or put it into your fund, and that's great, but then there's no guarantees on day one that supply doesn't outweigh demand, and you end up with more sellers than buyers and the share price going down. So, it's nice sometimes when you get them right. Look, we think that the silver price is going higher, and that is the fundamental structural driver of our position. But that being said, we think this particular project is underpriced, undervalued at the 25 mil market cap, and probably still at the current near enough 60 mil market cap. And there's scope for them to upgrade that resource. There's scope for them to do further drilling and expand the resource. Good team, good people, know what they're doing, and everyone aligned, which is what we like. So look, we outlined pretty much the thesis for silver, and
read the Livewire article in the
thesis
in the show notes.
The thesis for the business as well, on Livewire, I don't know, last week or earlier this week. So we'll put the link in the show notes. But yeah, so that's Sun Silver. But yeah, very, very pleased and nice. Nice week this week.
You do sound like someone who has had a big week of anticipation, and when you're describing it, you might have talked about Sun Silver a couple of times this week. It's showing, mate. I reckon you might need a morning in the water over the weekend.
Mate, I got there's good waves down here this morning. I'll give you the hot. It's really good surf at the moment.
Is that why?
I'm tired because
Is that why I'm in the podcast studio and you're at home?
100%. 100%. We've got a friend finishing up tomorrow in the office. She texted me and said, "Oh, would you want to come up for we're having, it's my last day. Will you come up to the office for a drink?" I just texted her back. I was like, "No."
I came from Tasmania to be here, and you.
I'm busy, bro. I got things to do tomorrow morning.
I got stuff to do, mate. Your IPO's launched. You rest of your
I'm going surfing.
Quiet.
I'm going surfing.
Things to do.
So yeah, no, I was in the water for 3 hours this morning. So
very good. Very good.
I'm actually tired. But mate, look on the markets though, like real quick. So
it's been good week.
The ASX is up 3.76% over the last month. The Chinese stock market is up 16.34%. Now, I don't like being right, but in this case, you did hear it on the
Wealth and Toil podcast.
Correct. So that market is certainly bouncing back, and if you are overweight emerging markets in your global equity SMA like I am, that sort of move gets you all worked up. So I'm very pleased to see that
specifically happening. Asian markets as well. I mean, both of us are pretty hot, have been hot on Asia for 12 months. And we talked about how Fidelity as a manager, holding much more than, say, GQG, both funds that we use, not product advice, by the way, but, that exposure to China now has changed their performance dramatically in a very short period of time.
In my haste of recording this podcast, I haven't actually checked what the returns on Fidelity Asia are for the last month, but the numbers will be out again on. We'll get the numbers shortly, but
we'll put it in the show notes. I'll have a look.
It's going all right. It's going all right.
Yeah.
Net. Look, that's
I'm sure
that's very pleasing, and I think the other nice part of the market is the industrial sector of the ASX relative to the resources sector is starting to get active. So, resources up, let's call it 96 basis points as I stare at this over the last month, while the industrial sector's up 2.5%. So we're certainly starting to see industrial companies outperforming resources, and that trend starting to emerge again. Or that it's just a constant sort of up and down relative to each other, but that is pleasing. So no, very, very. I like the markets. Everyone always asks me, what's the market going to do? What's the market going to do? The markets look as good as they've ever looked. You have got cyclically low earnings bottoming or have bottomed in certain sectors. You've got valuations that are average based on those already depressed earnings, and you're starting to see inflation roll over and interest rates probably under pressure at some stage in the next 12 to 24 months. Now, you can try and finesse that as much as you like. That environment is Goldilocks conditions for risk assets, and specifically it's Goldilocks conditions for equities. So I don't care who you are. You can buy the best property with the most capital growth in Australia. I'd be willing to bet you're not going to beat equities over the next 5 years from here. Just not going to happen.
Yeah, not on a pure return, perhaps on a leveraged rate, but that's a discussion.
Yeah, maybe.
Yeah, well,
maybe. If you still need to borrow money, you're probably not going to be a client of mine anyway. So,
borrowing for investment. It was funny. We were talking about this before the podcast, and I with the recent rate discussion, I know we wouldn't talk politics anymore, but doing a comparison where borrowing for property or borrowing for investment or paying down your home loan or investing in the market, like doing a comparison against those, I think would be a really interesting thing to take a moment now and then look at that over the next 5 years, because rates are 2 or 3%, happy days, right? Like, borrowing to invest against the equity in your home makes a lot of sense. It's easy. It's not costing you a significant amount. Ironically, you're a big believer in paying down your home, whereas I'm probably a big believer in using the funds to create additional tax-effective debt and continuing to invest in things like equities and more listed secondary markets. So, interesting.
I think it's horses for courses, that stuff. Like, if you're, depends on your tax, how much tax deductions you can get elsewhere. You know, if you've got fortunately for people like Dylan and I who are, essentially self-employed, we have plenty of levers to pull to reduce our tax. Whereas, if you're an anaesthetist, you have less levers to pull to reduce your tax. So, we'll put it this way, less levers to pull without using debt. So I think that it is horses for courses. I obviously talk about, my situation, and I think that's good. But, I understand, mate, why you would think that way and in what circumstances that would work for people.
Yeah, absolutely. Interestingly, just looked up the year-to-date on Fidelity, 5.5% since January, and there was a fall in Jan. So,
year-to-date. Why you give me year-to-date numbers still?
We're talking about three months. So
I want to go. Oh, that's okay. So that's the quarter.
That's what we're talking about, right? So
no, I was talking about the rolling month.
Okay, all right.
But year to date, the China market's up 12. So
there you go. I mean, they're not 100% China though. So
that's correct. So it'll be interesting. I have to go check them versus their benchmark. Emerging markets more broadly up 9.5i. So still 5.5, not that good. But let's see how those numbers look at the end of June 30. I reckon that'll sort itself out.
Yeah, absolutely. But no, interesting market. Look, I mean, I don't know about you. Talking to clients generally, there is a little bit of fear around investing in some of these markets, emerging markets, but particularly China.
Why?
Well, I mean, cloud of information, right? So, it's a different regulatory environment. You would argue.
Yeah. Are these clients pretending like they understand the Australian regulatory environment as a basis?
It's not about that. It's the same conversation we had a few weeks ago about clients wanting to buy the top 20, the top 10 stocks because it's what they understand, right? Like it's easy. They don't understand it.
They don't understand it, and they feel like they understand it, and that's the difference, right? So I think that the problem with people is they pretend they understand stuff, and they don't. So if you don't understand BHP, and the thing that you understand about it is that everybody else owns it, and that makes you feel good. Well, great, but let's not pretend that you actually understand what you're doing.
Well, I think that's the same concept with CBA and even banks, right? Which are some of the simplest companies on a surface level, but probably some of the most complex on an in-depth level about how they make their money. At least BHP digs things out of the ground and
sells them, puts them on a boat and sells them to China.
It's not that hard, mate. Just dig a hole and then sell it to China.
Good afternoon to everyone listening to us in Western Australia. Dylan's just slagged off your entire industry, so that was
Thank you for your GST contribution.
This is what the Tasmanians think of your GST.
We appreciate it. We appreciate it.
All right, Dylan, that's 30 minutes.
That's 30 minutes. I reckon we don't have any more. We got nothing more. We got nothing to give. I've actually got plenty, but you're a shell.
I got stuff to do. I got to go and
the tide's coming in or going out or whatever.
No, I got work today.
Oh, yeah. Funny that. Spend all morning in the water and you end up with an afternoon.
Yeah, that's correct.
And then I'm on your case trying to record a bloody podcast.
Well, you're late. You're late. So that's why I'm pissed off. So let's go.
A wizard is never late. He arrives exactly when he means to.
If that's something from Harry Potter or that I don't understand, I don't know.
It's from anyway. If it's a reference from somewhere.
Have
a wonderful afternoon, Luke. All right,
you too, Dill.
Yeah, I'm gonna go. I'm gonna go and spill coffee on your desk or something.
Have a good week, guys. We're back next week.
Take care. See ya. Bye.
See you, mate. Bye.